Hey guys, it is Julie here with TipRanks. In today's video, we're taking a look at 3 stocks that analysts from BMO think could grow over 60%. So let's get into it. Alright guys, welcome back and thank you all so much for being here. Today we're looking at 3 companies whose stock has been rated a buy from analysts at BMO, and they're predicting some pretty impressive growth for the stock's future. So we're going to take a look at what these companies do and how the other analysts weigh in as well. Just before we get into all of that, this is your friendly reminder that if you enjoyed today's video, make sure you hit that thumbs up button and that you're subscribed to the channel as well. Okay, let's get right into these 3 companies, starting off with ZVIA. Their stock trades under the ticker ZVIA and is currently priced at about $13 per share. ZVIA is a soft drink company whose name comes from the stevia sugar substitute that they use in their product lines. The company has a full line of sugar-free energy drinks and organic teas, plus they just launched a root beer that are all 0-calorie, gluten-free, and vegan-friendly. All of their beverages are made with only a handful of plant-based ingredients and are non-GMO project verified. Between their 6 product lines, they've sold over 1 billion cans. They have a 45% loyalty rate or share of stomach and have eliminated about 47,000 metric tons of sugar from consumers' diets since their launch in 2011. ZVIA just hit the public market in July with their IPO. They released about 10.7 million shares onto the market at $14 per share. This IPO raised them gross proceeds of $150 million. Just last month, ZVIA released their first quarterly earnings report as a publicly traded company. Their results showed top-line revenue of $34.4 million, which was a 24% year-over-year gain, and an earnings per share loss of 30 cents per share. They reported $16.2 million in gross profit for the quarter. Weighing in on the ZVIA stock is analyst Andrew Strelzik from BMO. He says that ZVIA has the potential to become the dominant, scaled, better-for-you beverage brand in its categories, as there is no leader today. The consumer shift to better-for-you beverages is in its very early days, despite consistently gaining share from traditional beverages. ZVIA already has proven its ability to make real inroads, and there is a misperception about competition, as there are only a handful of better-for-you alternatives in each of ZVIA's categories. Since their IPO, the ZVIA stock has picked up 6 analyst ratings and currently comes in as a moderate buy based on 4 buy ratings and 2 holds. Their average price target comes in at $19.25, which would be an upside potential of over 46%. On the low end, we do have a hold rating at $14, which would be an upside of about 6%, and on the high end, we have Andrew's price target of $24, which would represent growth potential of 82.5%. The second company on our list today is called LICY. Their stock trades under the ticker LICY and is currently priced at about $8 per share. Now, this company is in the battery recycling niche. They work to recover reusable material from expired lithium-ion batteries. Their proprietary spoke and hub technologies use a combination of mechanical safe size reduction and hydrometallurgical resource recovery specifically designed for lithium-ion battery recycling. On the spoke end, we have all types of lithium-ion batteries being transformed from a charged state to an inert product in a safe and efficient manner. And on the hub side of things, cathode and anode materials are processed into battery-grade end products for reuse in lithium-ion battery production or other applications in the broader economy. Now, the demand for batteries is increasing exponentially as people focus on green, emission-free technologies like electric cars, and therefore, the demand for battery recycling will be growing hand in hand. LiCycle says that the pace of new battery manufacturing facilities is far exceeding their expectations, and recycling volumes are growing in lockstep with manufacturing volumes well in advance of the end-of-life tsunami. The company estimates that by 2030, the battery sector will generate over 15 million metric tons of used-up lithium-ion batteries, and these contain unusable pollutants, but also plenty of recoverable elements. The company boasts that it can recover some 95% of the material in the batteries without sending waste to the landfills, and returning large quantities of aluminum, copper, lithium, and other elements to the battery manufacturers. This month, LiCycle shared their third quarter earnings report, where they showed an impressive 840% year-over-year growth in revenues. Their gross revenue came in at $2.18 million, while their net revenue came in at $1.71 million. This was also their first report as a publicly traded entity after they finished a SPAC combination on August 11th. That SPAC merger brought LICY $580 million in gross proceeds. Weighing in on the LICY stock is BMO analyst Robin Fiedler. They said that LICY is well-funded and has a plausible pathway towards feedstock security required to reach scale and robust profitability potential. This stems from LICY's strong OEM partnerships and proprietary recycling process expected to drive more favorable raw material recovery yields and lower environmental footprint versus peers. They added that we believe LICY has significant midterm earnings potential under what we deem as reasonable key driver assumptions and capacity rollout trajectories, with even further potential upside if management guidance is achieved. Now, the LICY stock does just have 3 current analyst ratings and comes in as a moderate buy based on 2 buy ratings and 1 hold. Average price target comes in at $13, which would be an upside potential of 61%. On the low end, we do have a hold rating, which would still be a 38% upside, and on the high end, a $15 price target, which would be an 88% growth potential. And third on our list today is Dave & Buster's. Trading under the ticker PLAY, they're currently priced just shy of $35 per share. Dave & Buster's is a well-known restaurant and entertainment venue across America. They have a combination of bar, sports bar, video arcade, and gaming venues for grown-ups. The company has over 140 locations across the US and Canada where patrons can eat and drink and play games. They're also well known for hosting bachelor parties and have definitely seen an uptick in this as pandemic restrictions ease. In fact, it seems that consumers have been so eager to return back to normal that in 2021 already, Dave & Buster's has recouped all of its lost sales from the COVID pandemic. And that was no easy feat. By the second quarter of 2020, the company's revenues had fallen from their pre-pandemic levels of about $340 million to a mere $50 million. But as of their second quarter 2021, the company was reporting $377 million at the top line, the best quarterly result in over 2 years. Their earnings per share was also up, with the company showing 4 consecutive quarters of losses in 2020 and now finally returning to profitability in 2021. Once again, we're hearing from analyst Andrew Strelzik from BMO. He says that sales trajectory inflected mid-quarter, and despite some quarter-to-date moderation around weather and COVID, the business trajectory remains upward. A strong consumer environment and internal initiatives combined to capture strong demand for socialization. We believe the sales acceleration was broad-based across geographies, demonstrating Dave & Buster's resonance in the consumer climate during the quarter. Now, the Dave & Buster's stock has 7 analyst ratings altogether, and once again we have a moderate buy, this time based on 4 buy ratings, 2 holds, and 1 sell. The average price target of $49.29 would be an upside potential of 41%. For our low-end ratings, we have both the sell and the hold rating at $40, which would still be a 16% upside. On the high end, we have Andrew from BMO with a $58 price target, which would represent growth of 68%. So there are 3 stocks that BMO analysts are predicting some pretty sizable growth for. Now, I'd love to hear from you guys in the comments down below. Let me know your thoughts on these 3 companies and what you think about their growth potential for the future, or what other stocks are catching your eyes lately. I always love hearing from you guys. Please keep in mind that these videos are never a suggestion to buy or sell any specific stock and are just meant for information and entertainment purposes. Please make sure you're always doing your own research and due diligence before making any investment decision. Thank you guys all so much for watching. I hope you have a fantastic day, and I will see you back here next time.